A year ago, when I was talking about data sharing across banks, I was seen as a lunatic. Frankly, I think everyone thought I was having a manic episode when I would go off on my rants. But what we all agreed on was that the data collection process was a cluster. Are you going to believe me? No, the data collection process is a nightmare for them. And that's something that they could resonate with, understand, and immediately act on. It was a hair on fire problem. We started working with them on use case specific workflows. Right before the network, we were originating $400 million in lending volume a month.
The views expressed in this podcast are the speaker's own and are not the views of This Week in Fintech or any other person or entity. The content provided in this podcast is for informational purposes only and should not be construed as legal, business, tax, or investment advice or a recommendation, solicitation, endorsement, or offering by me or anyone else for the sale, subscription, or purchase of securities or for investment advisory services of any kind.
Thank you, everybody, and welcome back to This Week in Fintech's podcast. I am your host, Nick Milanovic, and I am very excited for our conversation today. Today, I'm speaking with Georgina, the founder of Solo. You might know Georgina and Solo because we actually just co-authored and published a joint piece with them earlier this week, talking about the launch of Solo's multilateral open banking network. Their collaborative network creates a single living source of truth for financial data. This is something that can be super disruptive to the age-old world of open banking. And so I'm very excited for us to learn a little bit more about it and about Solo's differentiated approach. Thanks, Georgina, for joining us today.
Thank you, Nick.
It's good to have you on, but even before we dive into Solo, I'd love to get a little bit more of your background. How did you come to this and how did you come to being a founder?
So I started my career actually in public policy, realized very quickly that was not for me, and then was trained as a data scientist in cybersecurity. And so data collection in cybersecurity looks very different than in banking. Everything is very interconnected. It's nonlinear. It's very collaborative because that's how everyone keeps, each other safe, is through this very collaborative, nonlinear approach where everything connects back to a single source of truth. Technically, it's built like knowledge graph systems, if you think of Palantir and how their data architecture works. And so that was kind of my initial reference point to how data collection should work. Collaborative, nonlinear, and always referenced back to a single source of truth. During COVID, I founded my first fintech, which was very much a right place, right time. It was an SMB and freelance lending platform for unbanked people in Egypt. And, we thought that we could leverage tech and a lot of open banking and open finance to automate most of the process. Very quickly learned that just because data lives in an API does not make it usable. Still requires a lot of research. There's still so much inefficiency around data collection in the context of underwriting as well. And there's no single source of truth that you can pull from as a lender. So we ended up scaling that company to 40,000 transactions. But we also had a team of over 100 CPAs in the Philippines that were doing a lot of this manual back and forth with the customer and collecting JSONs from different platforms and trying to standardize that in our language. And so for a bank, that was very attractive economics, like 100 or just 100 employees on 40,000 transactions. It's a steal. But for a venture-backed business, that was not very attractive. So sold that company to the National Bank of Egypt, which was, a story for another day, maybe over a drink, and founded Solo. And Solo is a collaborative customer data sharing network for banks and fintechs. So legally, we're regulated as a credit reporting agency, but practically, we're built as a relationship engine. Which means we are involved in automating all of the back and forth of collecting the customer data. So we know exactly how it was collected. We're involved in the process of data collection, not just the sharing. And because we operate as a network, banks and fintechs don't duplicate the same work. So if I've already seen Nick before in a different context, and I've asked Nick all of these questions, a different lender in the network onboarding Nick will skip straight to just the application being pre-filled, Nick consenting to reusing all of the information he already contributed. And we've saved everyone a lot of time and a lot of money, and most importantly, the consumer, a lot of the same repetitive work. So yeah, this is what we believe to be the future of true open access, is this collaborative ecosystem where we don't have to start from scratch with every customer interaction.
In the write-up, we talked a little bit about the transition from Encyclopedia Britannica to Wikipedia as a good analogy. To me, it feels similar to moving from Yellow Pages to a CRM like Salesforce or a social media platform like Facebook, where you basically had one authority previously that was publishing all the information, and you hope that their records are up to date, which year to year is not necessarily a guarantee. And then all of a sudden, you move to these collaborative platforms where the inputs are federated. And so you have different trusted sources, each of whom is inputting their own piece of information, and you can kind of vet the log to see who put in information at what time about what person and keep it up to date. I'm curious, with regards to Solo specifically in your network, how do you think about the different participants that are contributing to this ecosystem? Do you have kind of categories? And how do you think about the continual validation of data that's getting added to the network?
So we view data sharing. I think if you look back at why it operated the way that it did for so long, starting with the bureaus, right? The bureaus had data furnished to them through Metro 2 files in spreadsheets. And there was an assumption in standards around how that data got there, what information would be prevalent in that spreadsheet. There was an agreed upon standard that all regulated institutions were going to follow for that one narrow piece of data set. And as we evolved, a lot of that data now doesn't come from the banks. It comes from fintechs and lenders and credit builder products. And so that same infrastructure that existed in the past, where we had what we call at Solo implied lineage. Implied lineage is like, we can assume we know how it got there based on the rules. We're moving away from that into a world where there's decentralized data collection, and you wouldn't be able to tell me as a consumer who has collected what in my lifetime and how it was collected and how it's potentially being used to determine my fate in potentially getting a lease, in getting a financial product, in all of those categories. And so we moved past that into a world where we need faster access to a different data set that is also still quite narrow, but would move real-time information from the banks to fintechs. And now we're entering into a third era, right? And so this third era is where the data lives everywhere. There is no centralized single source of truth that is conclusive. Conclusive as in we're talking about liability data, we're talking about application data, we're talking about identity, financials, transactions, relationship data. There's no single source of truth where everyone contributes to. And downstream, we have a lot of reset and inefficiency happening, but then a lot of fraud because there's no accountability. When you don't have a network and there's a reset that happens every time someone goes into a new service provider, I can say whatever I want on an application and there's no accountability on what is said because there's no memory of it outside of that single institution. And so up until this point, it had made sense that data collection was one direction, right? And I think that now we're at a pretty critical moment in the industry where we have an opportunity for everyone to be part of this ecosystem where they are both consumers of data and also contributors of data. And I think previously there's been, why has this not existed? And we could talk about that not just in the context of fintech, but also in healthcare. It's a data portability problem because you don't have a collaborative ecosystem. And so what's missing to be able to enable that is for Lineage to not be implied, so the data that is collected outside of regulated institutions can be reusable by institutions. Because if we're truly trying to solve for open access, someone that's been on credit builder products and payday loans should one day be able to qualify for a mortgage if we believe in true portability, which means that we need to know how that credit builder product and how that payday lender collects their data so that banks can still comply with regulations to be able to offer a mortgage. So that's one piece that's really missing. The other piece that's missing is the incentive model. So, we're having this conversation and it's been quite a heated debate for not the right reasons, and it's the value of data and the value of, who owns it, who should be paid or compensated. And the reality is we believe in a model where the originator of the data, the person that owns the provenance and the lineage and how it was collected, is compensated when their data is reused downstream. It's not by institution type, because fintechs are very much data providers in this day and age. Aggregators are data providers in this day and age, but they're also data consumers. And so we need to have a rules-based system where your contributions are governed and compensated based on the role that you play in the transaction, not just by the label you have on your institution. I'm a fintech, therefore I'm always a data consumer, therefore I'm always paying for data. That's not true. Sometimes you contribute information and you should be compensated. Similarly, an aggregator is consuming data from institutions, but they're adding value and adding enrichment and adding potentially scoring or signals. And once that's reused, that should be compensated. So it's looking at it in a different way. And I think it's important for incentives to be right, for data sharing to actually work, because otherwise there's incentives to keep friction in our system, which is not good for anyone.
This is very resonant because in a past life, I was responsible for furnishing all of our Metro 2 reporting on behalf of a credit program to the bureaus. And you won't be surprised about this, but I think people who don't have familiarity with that process would find it insane how much incorrect or inaccurate or outdated information gets provided to the bureaus. And we're talking about very arcane formatting for these reporting standards. And we don't have a good process for consumers to adjudicate information if it's wrong, or even for the furnishers to update this information if it turns out that it's wrong. And so we get into this process where it's very manual, very time intensive, and you basically have information that's contested. And if you're applying for a mortgage or an auto loan or even a credit card, stretching out an inaccurate file reporting contestation period for months and months will have a significant impact on your life plans. And so I think the value proposition is super clear and the consumer impact is super clear. I'm curious, how do you think about the different level of information needed for different products and applications and providing the right level of identity and data access based on the need? So for instance, you have somebody who's applying online for a credit card. Well, there's not that much information that I need to actually share with you in order to get access to a credit card. Maybe credit bureau history, social security number, a little bit of self-reported information about my salary. If I'm applying for a mortgage, totally different picture. If both of those use cases are right for the solo network, how do you think about providing the right level of information based on the use?
So I think this is a great question, first of all, and I have a lot of empathy that you were in charge of the Metro 2 files. But so how this works in practice, and it has a lot to do with how Solo came to exist as a company. Because we historically, before even this network started, were tasked with making the customer data collection process for banks and lenders more efficient, we started in the workflow space of how do we automate these onboarding, servicing, and origination workflows. And so if you think about how this works in practice, Solo is, even though we are like a credit reporting agency from a regulatory standpoint, we were built as a relationship engine. And as a relationship engine, we know the context of what's being asked. And so Solo in practice looks like if you are onboarding, we will read the fields of what is being asked of you, right, by the institution. So if it's 18 fields, some of these are self-reported, some of these require third parties like KYC or like employment. Some of these are document uploads. Depending on what is required, we will query those data fields in our existing network knowledge graph of Nick. So we'll be like, guys, who has seen this guy before? And I'm looking for these things. Do they exist in the network, right? So let's say that 6 out of the entire application, 6 fields we managed to find. Then we have to match that against the bank's policy. Okay, will the bank accept what was submitted by this fintech because of their KYC vendor? Because the KYC vendor needs to be whitelisted by the person accepting it for it to be reused. Does the address and how it was collected match the bank's policies? AKA, does it have 2 utility bills attached? Or does it come from a bureau? The credit score, was it pulled recently enough that it makes sense? So we go through the rules of each data piece as it's requested. And this is all happening in real time. It sounds very long, but this is our engine in practice. It's all happening in real time where we're essentially resolving what the bank needs for onboarding with what exists in the network and if it meets the requirements. In half a second, you will get a checklist with what we already have and your permission to reshare that. And so you would consent to resharing the information versus writing out all of these things or finding that document or, taking a picture of your passport or whatever it is, right? Solo is unique in that you don't need a full network knowledge for it to still work because we're involved in the data collection. The next step would be for us to resolve new information with you. And it's called the resolution engine, which identifies the gaps in what we have with the workflow requirements. So we would ask Nick, okay, these are the things we need from you. We promise you will never answer this question again, not here and not anywhere else. And so we collect that, and it's the last time we collect it until it expires. And then for the originating institution that is now taking in Nick for whatever application that is, they've actually built up an asset that is going to be reused downstream by other participants in the network. And they will be compensated essentially for building that relationship with you and servicing you and vouching for you when someone else needs it in the ecosystem.
So I'm curious, what does that product look like on the consumer facing side? In my mind, I'm really thinking about, let's say, Google OAuth, where I go to a new service provider or a new site. I'm signing up for a SaaS product. I've never been to the site before, but I can log in with Google OAuth. And for me, that's just easy because I don't have to create a new password. I don't have to enter any new information with them. It's all stored someplace with Google where I can go and look at all of my OAuth subscriptions and I can permission or depermission data. And so I just don't have to enter or create new information. Is that kind of similar to what the Solo experience looks like?
It's similar without a login because we proxy it based on the institution that's implemented the SDK. So it is a very similar, but that's a good analogy. It's very similar in that way, in that you surface it back as a pre-fill to the consumer with the exact fields that are going to be reshared, and then they consent to it. And separately, we have a direct relationship with the customer as the credit reporting agency so that they can manage their permissions. If there's anything that needs to be appealed or disputed, they have direct access to be able to do that. And unlike the traditional bureaus, we don't charge you $37 a month to look at your own information.
That is ridiculous. By the way, I can't believe people are still paying just to be able to look up the information that they're sharing. You're applying for a credit card and you have no idea what information the credit card company is actually seeing because you have to pay to access your own information. It's ridiculous. I'm curious, for Solo, I know that the product is starting focused on financial services, but do you have aspirations to go beyond that? Because when I think about the underlying technology here, it's basically an identity information solution. And you can think about so many more applications and use cases, getting insurance, sharing your medical records if you're going into a new hospital. I'm curious, what does the future look like for you all?
Absolutely. We view this as a horizontal space. I think banking was long overdue because of how linear the process is, and the economics are too disastrous to ignore in that space. But we absolutely think that the road ahead includes other industries. Insurance is a great example. Healthcare, there's a lot of regulation there. We're already heavily regulated as a credit reporting agency. So I'm not too sure if healthcare is in the plans, but definitely looking to expand beyond financial services in the near future.
I'm also curious to hear how you incentivize new data providers or furnishers to come on. You talked about compensation, and to me, that seems like such a smart incentive alignment mechanism. Basically, I'm sure that you have a lot of institutions that are asking, why should I provide data on behalf of the user to this network? But if they're incentivized because every time that data is pinged, they get compensated, it makes sense for more and more participants to join the network. I'm curious, how does that incentivization mechanism work?
I mean, I think if we were having this conversation maybe 10 years ago, and I know that the original open banking players really struggled with that, and I think that they walked so that we could run in that sense. If we were having that conversation 10 years ago, it would be very different. But the conversations we're having now is, we're not saying share the data with us and we'll pay you like there's an illusion of choice, Nick, is what I'm trying to say very politely. There's an illusion of choice. It's already happening and there are other methods to get it. Do you want to get paid or not? So I think that that's the reality that we're in right now, is that it's not like they have a choice and they know that. And I think the most recent kind of debate in our space has centered around that, but it's an illusion of choice, not just for regulatory reasons, but because there are other players that are doing it in different ways. And we are the first player to say, we want to build this with you as a network. And we understand that alignment incentive is really important for us to build a sustainable future. The first thing I learned in business, it was my uncle. I grew up in a family business. And, it was around incentive alignment. If the stakeholders are in your industry, if there are broken incentives, eventually the model will break, right? It's not real. It is dictated by one player that woke up in the morning and decided this is the price for something and never negotiated with the supplier, right? And so you wake up 10 years later and obviously we have a fist fight happening, right? Like, obviously, what else did we expect? So I think in this conversation specifically around financial services, it is incredibly dangerous to have the wrong incentives, because data it's not just ownership in the context of privacy or monetization. It's ownership in the context of data represents your relationships and trust. Back in the day, your banker knew you and there was accountability in the community because they knew your family and they were able to vouch for you. If they couldn't service you or help you, they were able to help you. And they were probably, working collaboratively with other people in the space to make sure that you get serviced, whether it's coming from them or someone else. Now that we don't have that and we've moved away from the in-person stuff, and your data is the thing that's a proxy for the trust that you've built with all the institutions, we need an ecosystem where if I've built trust with one institution, that can be easily ported, and not just easily ported, they should be rushing to vouch for me as a consumer if they can't help me. And so the incentive model is not just like the business model, it's the way that we build a sustainable ecosystem around servicing end consumers, if open access is truly the goal here.
You said the magic words. If this was Jeopardy, the daily double sign would have flashed, because you mentioned the US regulatory environment. And I'm very curious to hear your high-level thoughts. For people who are familiar with open banking, in Europe, open banking has been part of PSD2, Payment Service Directive 2, for over a decade. The UK Open Banking Implementation Authority made it so that the top banks by assets provided open APIs to their access in the UK, again, for over a decade now. In the US, we're slowly marching in that direction. And a year ago, the CFPB came out and said, we're going to start enforcing Dodd-Frank 1033, which is a small portion of the Dodd-Frank legislation that says, at the end of the day, consumers are the ones who own their financial data. So if you're a consumer and you want to be able to leverage your financial data for applying for a new product or even just loading it into a financial management app, you should be able to do that. Today, the bureaus walk back that guidance, and it doesn't look like it's a sure bet anymore that consumers are going to be able to own their own data. And so what we have is we see banks like JP Morgan that have come out and said, we're actually going to charge for access to this data to the aggregators. And so it's not as much of a sure thing anymore that the consumer power to own your own data is something that's defensible in the US. How are you thinking about the current climate, and how do you think we kind of move past this period?
I think the first thing I'll say is just because Europe did it one way does not mean that we do the same here in America. That's why a lot of us moved. Okay. Not to get political, but just that as precedent, I don't think is precedent. I think 1033's intention, and I could say this because I've actually spoken to former Congressman Barney Frank about the initial intent behind the Dodd-Frank Act, and we have some of this recorded and on our website. We hosted a town hall last month. Dog years, startup as it feels like much longer, but it was last month.
Years.
Yeah. So, the intention behind the Dodd-Frank Act, which is how 1033 originated, was to make institutions accountable to consumers. Okay. And those are in the words of Barney Frank. It was not to make it so that the work of institutions gets extracted by one player or two players or maybe three players. And we build a fourth bureau with a broken business model, because my entire belief around why the model is broken for open banking, traditional open banking, is we are rebuilding. It's like the same exact model as the credit bureaus, but these people just brute forced everyone into it, versus the bureaus actually had contracts. And just to kind of clarify what I mean by that is you're getting all of the work that's done by the institutions and you're selling it back to the same group of people. So it's a very strange value exchange. But that aside, I think that 1033's intention is to facilitate open access and make sure that there's customer data portability, not codifying an existing model into law. And the existing model was dictated by just a few people, right? And so the contentious debate around 1033 is because this is an industry-wide problem. The institutions are fronting the cost for it. Consumers are involved. Fintechs are now very much equal participants in both the data consumption and the data providing. And we have basically kind of decided, well, we didn't, the original CFPB, last CFPB, decided that the way that we were going to solve for that was by codifying into law what a lot of people were against in the first place. And so that's why you have people coming out now, banks coming out now saying, well, that's just not going to fly, right? We're not going to create a fourth bureau. And I think that the largest open banking player conceding to essentially the model that we've proposed makes it so that they just conceded to our model being inevitable. So the future of open banking, solo is the inevitable model, whether it exists in solo or someone else does the same thing. That is the inevitability. The largest open banking player paid the largest banks. We now need something where it's not a one-off deal. We need to make sure that this infrastructure that was built, and I have so much respect for the people that built the infrastructure that got us here, because it was not possible to do this. It wasn't inevitable 10 years ago. It had to be done a certain way, right? And I fully acknowledge that. But I think it's time now where we have stakeholders that need to be brought in so that these dynamics don't become one-off deals where the largest open banking player pays the largest bank and then everything else is up in the air and uncertain to whether open banking will survive. And then beyond that, 1033 only governs very specific data types. And so as a company, we're actually very supportive in that becoming free. Those data types governed by 1033, transactions, assets, and account status or KYC, you want to make that free, make it free for everyone. The data portability should not end once the open banking player takes it from the institution, but then they can charge for it downstream. So if we're actually pro customer data portability at the basic level on those three data types, govern it by role, not by, company type, because we have moved away from the reality where the bank is always the provider of data and the fintech is always the consumer and the aggregator is the only one that can facilitate that. We've moved beyond that into multiplayer mode where I can both consume and provide data. And so I should have obligations when I consume data, and I should have obligations and responsibilities when I provide it. And so that's why we believe the network model is the future of open banking.
This episode is sponsored by Bridge, a Stripe company. Just as the internet made information global, stablecoins are making money global. And Bridge, a Stripe company, is the infrastructure powering that shift. Built for speed, scale, and simplicity, Bridge helps businesses send, store, accept, and launch stablecoins instantly. Serve global customers without navigating the complexities of setting up crypto rails. It's how companies like X, Shopify, and Airtime unlock new markets, reduce FX costs, and move money at internet speed. Whether you're a payroll company looking to use stablecoins for global contractor payouts, a remittance app looking to use stablecoins to expedite global money movement, a neobank in the global south hoping to offer stablecoins for dependable savings, or a treasury team wanting to use stablecoins to hedge against FX volatility in emerging markets, Bridge can help. Explore the future of global financial infrastructure at bridge.xyz.
When we talk about the right infrastructure and kind of future models and states for technology, something that comes to mind for me, especially thinking about a decentralized data product, is blockchain technologies. What's Solo's perspective there?
Interestingly enough, our first launch of this unified source of truth that everyone contributes to, it was not even called a network when it launched, was with a blockchain network. And we think it's I think thesis resonates very much with everyone in the blockchain space. I think for a while, we said we serviced fintech adjacent industries to avoid kind of, we come from the banking space. And so it was not very friendly a year ago now. But, I think we view the blockchain technology for immutability. We have a lot of the same principles as the original blockchain enthusiasts. I don't invest in things I don't perfectly understand as a founder. And so we've built our technology on just an AI native stack that is not blockchain native, but that could change over time. We do issue certificates on the blockchain as one of our modes for consuming the data. So we actually have that active today with a blockchain network called Kita, and their members are using the infrastructure to issue certificates on the blockchain, and that's how they're using it. But it's not native to us as a company, more so just a framework that I think there's a lot of parallels with, and an industry that we can service without necessarily being, a blockchain native ourselves.
Speaking of your users, I saw when you raised funds earlier this year, you mentioned that you were focusing on securing 100 bank pilots in the US. And I was looking through the numbers, and it blew my mind that banks pay $29 billion a year just to process applications, which seems like a massive amount that could be saved by contributing to a federated data network. I'd be curious to hear a little bit more about the conversations with banks. Do their eyes kind of light up immediately when you're talking through Solo? How do they think about contributing to the product? And do you have any high-profile partners or users that you can share with us publicly yet?
Yeah, banks are, where do I start, Nick? They are, we raise money from banks directly. Solo was built in partnership with our bank partners. I really believe that. The network came out of partnership with our banks, and you'd be surprised, right? Because a year ago, when I was talking about data sharing across banks, I was seen as a lunatic. Frankly, I think everyone thought I was having a manic episode when I would go off on my rants about data sharing. And even the word bureau was very scary to a lot of banks. But what we all agreed on was that the data collection process was a clusterfuck. I'm sorry. Am I allowed to cuss on your podcast? Are you going to bleep me?
It's fine. Definitely.
So, the data collection process is a nightmare for them. And that's something that they could resonate with, understand, and immediately act on. It was a hair on fire problem. And so we started by automating for specific use cases. Mortgage origination, very expensive process, lots of hands. And so for banks that are growing in that category, we started working with them on use case specific workflows like origination or servicing or onboarding. We grew to, right before the network, we were originating $400 million in lending volume a month for banks and lenders, high volume lenders, some fintechs. And then the network kind of came about quite organically because we started getting referrals. The bank tech ventures ecosystem is it's one big family, right? It's like all the CEOs are in a group chat. Everyone talks to each other. And so a lot of these banks are also partnered with each other on specific verticals. So you'll have like the SBA group at Capital Bank will do turn downs and give their deals to a lender that we work with, right? And so they needed to do cross-institutional data sharing on very narrow use cases. And we were looking across our existing clients being like, it's so great that we've automated the process for one bank at a time. But there's still collectively so much inefficiency. And I can see that end customer being asked the same questions, even though we've seen them before. And if you just let me open it up, I could solve a lot more problems for you. And so it was actually Tim at Choice Bank that initially was he's the chief operating officer at Choice Bank. They are the bank behind Mercury and a lot of other fintech programs. And we were talking about the reset in how much work they do, and then Mercury has to do the same work. And we started seeing the pattern in federated networks as either institutions that already work together, so need to do data sharing, or ecosystems where high overlap exists. And so our first couple of partners on the network are BaaS banks. I'm going to share two today, which we've never shared. So this is like the first time I'm ever talking about it, but Coastal Bank and Choice Bank are founding members of the network. We have since onboarded a couple more, but those are the two that I will publicly share today. That's like hundreds of programs, fintech programs that need to be data sharing across the network and go through a lot of duplicate efforts to, reach the same conclusion ultimately and go through the same cost and process, and then the customers just repeating themselves over and over again. And so that's kind of the how it came about was actually through our bank tech network and working with them on mostly just automating their data collection, which at the time was what there was appetite for, and then evolved into this data sharing network and collaboration across our existing, customers, but also across our investors and our network and their partners. And yeah, I feel like I've shared so much today.
No, this is one of the more productive therapy sessions that I've had recently. So I'm glad that it's working on both sides. Thinking about you and your background as a founder and how you came to this, I know that you are a cybersecurity researcher beforehand. And I found it really interesting that you actually worked for Bellingcat, which for people who aren't familiar, it's one of the most compelling investigative journalism resources out there to provide kind of unique information on geopolitical events. I'm curious a little bit more about how that background really informed your decision to build a data product and how it still kind of runs through the work that you're doing today.
Yeah, so I was hired almost straight out of college to Flashpoint Intelligence, which is a deep and dark web investigative cybersecurity company. And the interesting thing is they're like, well, you have quantitative background as a degree. You also speak Arabic natively, and you grew up in the middle of I grew up when the Egyptian revolution happened, and then the Muslim Brotherhood took over the country, and I grew up Christian. And so I grew up in a very messy geopolitical environment. And so they spotted me at the G7 and they're like, we think you'd be really, really good at this. And so they trained me essentially to leverage my quantitative background it was initially, training large data sets on how to detect illicit activity on the dark web. So think of like weapon trafficking and like terrorist recruitment on like Discord for teenagers that are gaming, and money laundering cases with fintechs. And that's initially how I got my start with data, was looking at the darker side of fraud and illicit activity and training the algorithms to be able to detect real threats from false positives. But then as we narrowed in, I was also tasked with the actual investigative work of following it and giving the models context on what to look for, and maybe slang that you would miss if you're just using an LLM, which at the time there were no LLMs, by the way, so purely algorithmic. So, that environment is very interesting when you think in the context of collecting data. You're collecting data for a case, you're like investigating a specific case. And when I'm visualizing like Multigo, which is the software that we used to use in cybersecurity, but you would look at a subject or a profile, and to be able to reach a conclusion, you would see everything else. It was an open source technology that everyone contributed to. So Flashpoint was a publisher on Multigo, but everyone else was a contributor too. And everyone that had something to offer, think of Bellingcat as well, similar structure, it would be mapped to that node in a knowledge graph. And you would have context. So when you're looking at a subject, you're not looking at them for the first time, which would be super unproductive, but also quite dangerous because you are missing so much context, and everyone is incentivized to share in that space. It's open source intelligence. It's a very different culture. There's no hoarding of information because it's very, very collaborative. So when I think of data collection in cybersecurity versus data collection in finance and the stark difference, from an architectural perspective, it is built as a nonlinear process. When you look at data collection in cybersecurity, getting an answer doesn't just take you to the next step. Based on the answer that you find, you know what to ask as the next question, right? And so it's nonlinear. Like you find something out and it takes you to a different node. The other thing is everyone contributes to a single source of truth, and you have a collaborative ecosystem. You look at finance on the other hand, and our definition of we've solved digital data collection is we've turned paperwork into forms. It's still linear. You are still, you finish the set of questions, regardless of what your answers are, the next page looks the same, right? It's linear in terms of the data being collected. It's not smart. It's a one-way resolution. You are providing data and the system is not asking you based on what you've said. It's just, it takes you through a form and it's like a facelift, but not really, it hasn't really changed the data infrastructure. And then it's not collaborative. It's not even collaborative within a single bank. Like you'll go to a bank that you've had a relationship with for 8 years, and they will ask you questions like they've never met you before. And it's because one system doesn't talk to the other system. And so they'll just re-ask. So when I think of the parallels, and it was so intuitive as I was starting the company to how I wanted to build it, that I don't think I even gave credit to my cybersecurity background, in that like, I'm not a typical founder market fit. You think of founder market fit and you think, are you a banker? And I'm so not. I'm a total outsider. Our team is like total outsiders. We're like a bunch of like policy and tech nerds, frankly, that come from other industries and just looked at the problem from a first principles perspective. But as you can tell, there's definitely a lot of cyber influence in there.
Look, as a venture investor, I can promise you, I would not be more excited if I saw a banker starting this product. It's interesting, you are the kind of core target user who understands the value of what you're building at Silo, because you've seen what happens when there is shady or poor information or false identity information online, which is happening more and more. I like your use of the term, getting a facelift for bad information. When I think of Solo, to extend that analogy, it feels like you're really in the business of providing good skincare for data hygiene, not providing the Botox to clean it up
that.
better.
You know how to talk to me. I feel like you get me now. That's exactly
skincare over Botox. Exactly. Thinking about the long term, we are kind of like checking through the list of hot topics for tech, but I have to ask this. In addition to blockchain, we're also in the LLM phase right now, where it's so easy to generate AI slop or false information. And when you have new technologies like this, the fraudsters are often the most sophisticated early users. They're the ones who are incentivized to say, hey, can I get an edge with this? And so now you have this huge growth of potential synthetic identity information. People who can spin up multiple different identities. People who can use the format of a driver's license to spin up photos of all these fake driver's licenses for identities. And when you're talking about an identity network with federated data sharing, especially if you come from a cybersecurity background, I'm sure that you're thinking about in the LLM age, in the AI age, how do we prevent people from federating false information? What are your thoughts on LLMs as we kind of go into this new era of potential fraud?
So the way that we view LLMs and our relationship with them is we view it as a way to automate the audit trail. So we will always look at a data object and its lineage in the network. So if a bank reports to me that this profile exists, we won't accept it into the network unless we know how it got there. So did you use an identity provider? If so, who is the identity provider, the KYC provider? Let's say it's Socure, or if it's Prove or whatnot. That our system will audit where the data came from, so that once it's reused downstream, whether it was a relationship manager that collected the information and we know that it's because they asked for certain documentation, it was uploaded, that's how the data got there, or if it was a third-party API that contributed to that profile, there is an audit log that exists, and it makes whatever you share across the network trusted, not because of who published it, but because of how it got there. Being able to automate very simple processes like give me the audit log for how this was collected, or ask this question if this happens, is our kind of relationship to LLMs. We think there are much smarter people in the space that are actually solving for fraud and synthetic identity. And we are partnered with a lot of these companies, but also they are data providers in their own right. We don't override that. We are simply the network that facilitates the reusability of them across the network from an efficiency perspective. And we make sure that that data that's collected, whether a third-party fraud data provider contributed to it or a bank contributed to it just through manual process, or it went through a different vendor, that there's an audit trail that can be passed through along with the data. And then there's a matching of if it meets the compliance requirement of the person consuming it. So the governance is really, as someone that is intaking this applicant, I have to make sure that it meets my policies if I'm taking it from someone else. And you don't have to trust this other person providing data in the federated network. You just have to match the audit log to your SOP. And if it matches, it matches. And if it doesn't, then we have to recollect it.
I have a million more questions, so maybe we'll have to find time for a round two. But I know that you're super busy, as any founder is, especially an early stage founder. So I appreciate you taking an hour out of your time to just talk us through Solo today. We normally like to end with a couple of questions, but do you have any call outs for our audience? Are there people that you're looking to hire or specific customer types that you're looking to bring on board? And where can they find you? What's the best place to contact you these days?
Yeah, so our website is www.solo.one, O-N-E. I feel like that confuses people, but it's solo.one. I'm on LinkedIn. I am very active, so I will answer any message I get. And we are looking to onboard fintechs at this stage that are wanting to be publishers and consumers of data on the platform. So even if you're looking at this as a backup plan for data sharing, if open banking explodes, we are happy to take the call. And we're hiring for roles in New York City. So if you're in New York and in growth or engineering roles and want to join a very fast growing startup, please reach out.
Perfect. Well, you all heard it here. Solo.one, the open banking Ghostbusters. Who are you going to call if open banking explodes? Call Georgina over at Solo. Georgina, thank you so much for spending time with us today.
Thank you, Nick, for having me. This was fun.